Nike stock trades at its 52-week lows and is down big recently. Does it mean Nike is a good stock to buy now? Welcome to Global Value. In today's video, we're performing a fundamental analysis of Nike using Warren Buffett's investing framework. We'll look at 6 key numbers before we figure out 3 different fair values to understand what Nike is worth in today's stock market. Plus, I'll share 2 special bonuses that could be the deciding safety factors when adding Nike stock to your portfolio. Right now, Nike trades for $71.42 per share. In its last day of trading alone, it's down 3.5%. Since August of 2023, Nike stock is down 32%. At the same time, the S&P 500 has risen by nearly 20%. In the last 5 years, Nike's lost 3.5% each year. In the past decade, it's a different story, with the stock compounding at 6.1% annually and beating the market for much of this time. When we go back before the global financial crisis, Nike has actually beat the market, compounding at 10.8% annually, even with their recent drawdown. Still, Nike stock has been cut by more than half from their all-time highs in December of 2021, even though they had a brief rally in 2023. Added to the gains in their stock, right now Nike pays a 1.96% dividend yield. They're a dividend growth stock, increasing their dividends for 19 years straight. Today, Nike's trading just 50 cents over its 52-week low, and that's down nearly half from their 52-week high. How big is Nike? As the world's leading global sportswear company, they have a $111 billion market cap. Nike stock fell after they cut their guidance, missed on sales, and warned about growing weakness in Chinese consumers. This led to the company having their worst day in history on the stock market at the end of June 2024. Since then, though, the company's continued to trade lower. Doesn't mean that Nike's a deal right now. Starting off, we want their average returns on capital to be above 14%. Think of these returns like your form when you're in the gym. You want great form and you want companies to create great value. Nike has earned above average returns in all of these years, even including in 2020. Since then, as the company's rebounded, its returns have gone higher, finishing at 25% in their most recent fiscal year. Overall, in this time frame, Nike earns 21.5% returns on capital, which are 3 times better than an average business. This is a big check on our first metric, a strong start for Nike. Now, what does Nike really do? Nike is the largest athletic footwear and apparel brand in the world. Key categories include basketball, running, and soccer. Footwear generates around 2/3 of its sales. Its brands include Nike, Jordan, which is premier athletic footwear and clothing sponsored by Michael Jordan, and Converse for casual footwear. Nike sells its products worldwide through company-owned stores, franchise stores, and third-party retailers. The firm also operates e-commerce platforms in more than 40 countries. Nearly all of its production is outsourced to contract manufacturers worldwide. Nike was founded in 1964 and is based in Beaverton, Oregon. Next, we want growth in their sales, earnings, and free cash flow. If you've got a good thing going, you want more of it. For Nike, they've grown their sales from their 2020 lows by 37%. At the same time, the company is back and much more profitable, with their earnings doubling. Their free cash flows, which are the most important here, have quadrupled. They're up 4 times. That's strong growth for Nike and solid business performance, even with the narrative that their growth has completely stalled. It's another check on metric number 2. Next, who owns Nike? Right now, there are 8 super investors who own Nike stock, and this is led by the Hillman Value Fund and Terry Smith's Fundsmith portfolio. Overall, it doesn't get bigger than a 3% holding. In our third metric, we want earnings per share growth. This helps us look at Nike from the view of an individual shareholder. Again, their earnings have doubled from their lows, and Nike's also bought back 4% of their shares. Their earnings per share are up, and it's another check on metric number 3. Nike is perfect so far. Our fourth metric is similar but even more important. We want free cash flow per share growth. Cash flows are the lifeblood of any business, and in Nike's case, these have grown even better than their earnings. While their earnings are close to flat in their last 3 years, their free cash flows have continued to grow over that time, rebounding from their lows and steadily climbing upwards. In their last 12 months, Nike brought in $4.36 per share of free cash flow. That's strong growth over this time, and it's another check on metric number 4. Nike has 4 checks so far, and things are looking great. Now, why don't we look at their dividends? Right now, Nike pays a 1.96% dividend yield. They're a dividend growth stock, increasing these in the last 19 years. But are their dividends safe, and will these continue in the future? That's the question we're trying to figure out through our bonus. We want their dividends to be covered by their free cash flows. Thankfully for Nike shareholders, this has been the case in all of these years except 2020. Since then, with their cash flows up, Nike easily covers its dividend payments. Nike grew these dividends 8.82% last year and maintained a 40% dividend payout ratio. Their dividends look like they're in strong shape, and it's a check on our first bonus. Now let's look at Nike's balance sheet. Great companies can grow, earn high returns, and don't use a lot of debt. Nike fits this mold exactly. The company only has $401 million in net debt as of the end of their most recent fiscal year. Over this time, they've generated $23 billion of free cash flows. This means they bring in a massive amount and could pay off all of their net debt with just 1 month's worth of free cash flow. Nike's balance sheet looks great long-term here, and it's another huge check on metric number 5. So far, the company is perfect. Before we find out how much they're worth, it's time for us to cover our safety bonus. Warren Buffett's teacher and the father of value investing, Ben Graham, wanted to see a current ratio bigger than 1.5 times. This is a key measure of short-term liquidity for how a company can pay its bills in a hurry. Thankfully for Nike shareholders, they've been way above this mark in all 5 of these years and today. Right now, their current ratio comes in at 2.4 times, which is well above this. It's a solid check on our safety bonus. Both long and short term, Nike's balance sheet numbers look healthy. Now, what is Nike valued at? The big metric of them all, metric number 6, is today's first valuation. We want Nike's average cash flows divided by their enterprise value to give us a yield greater than 5%. This would match the historical yield from the S&P 500 and be greater than the 10-year Treasury. Today, Nike has a $111 billion enterprise value, which is what we get when we add their market cap and their net debt together. This helps us look at Nike more like it's a private business. In an average year over this time, the company brings in $4.7 billion of cash flows. When those are divided by their enterprise value, it gives us a 4.2% yield. In their last 3 years, they've had a 4.8% yield, and in their last 12 months, they brought in $6.6 billion of cash flow and have a 5.9% current yield. Things are split for Nike on an average and a current look here. However, because a single year's cash flows can be meaningless, we need to take the average, which Nike is slightly below what we wanted. This means coming in on metric number 6, it's our first and only X of the day for Nike. Don't just throw the business out. We still have 2 more valuations to look at before we find out Nike's fair value at the end of the video. Next, let's give Nike credit for its growth through a DCF model. We'll take their cash flows and grow them using historical assumptions. Remember, it's up to you to do your own homework here. We're going to assume that Nike grows their cash flows at 10% annually in the next decade. Then in the next 10 years from there, this growth would be cut in half and they'd only grow at 5% annually. We're also adding in the company's tangible book value to estimate their net worth. Then we want a 15% market-beating rate of return, which is the same return Warren Buffett wants from his investments. If that's the case with today's multiples based on a DCF valuation, Nike has around a $63 fair value. That's down $8 from their current stock price. Remember, this is just our second valuation, and there's still more coming before we get to the end of the video. Right now, Nike's valuations are at a decade-long low. They're just trading for 2 times sales and around 19 times earnings. This comes as the company's trading around 17 times EV to free cash flow. Historically, though, the company underperformed in the last decade, with a lot of this coming from their multiples being cut over this time. Still in its history, Nike is a long-term compounder, even with a recent haircut. For a long time, the company was owned by Berkshire Hathaway through its Geico portfolio managed by Lou Simpson. Today, when we look at estimates for their future and their current multiples, our third value comes in at $124 per share. Even though Nike's numbers look good and its stock was owned by Warren Buffett's company, it's not the numbers that he cares about most. Nike's qualities are the most important. Why don't we learn what these are through a long and a short thesis, which we'll start with a long thesis first. Number 1, the global sportswear market should expand, especially in Asia and other developing regions. As the market share leader in most countries, Nike is best positioned to benefit. Number 2, Nike's restructuring efforts to achieve $2 billion in cost cuts through its triple-double strategy of increased innovation, direct-to-consumer sales, and speed should allow for improved margins. And number 3, while Nike's recent margins have been somewhat depressed, their gross margins may rise through automation, e-commerce, and higher pricing. Nike's pulling back from undifferentiated retailers to increase full-price sales. But things aren't all positives. Let's look at a short thesis as well. Number 1, as a global business, Nike has felt the effects of wars, shipping delays, currency volatility, and inflation. These and other issues could continue to impair its results. Number 2, the Chinese sportswear market is increasingly competitive as nationalism has boosted native brands. International brands like Lululemon have also expanded there. This means Nike must continue to lead this market to meet long-term profit goals. And number 3, Nike's dominance in running shoes has been challenged by the success of relative newcomers like Hoka and On. It's even fallen behind some others in innovation. Now let's put everything together for Nike. In our fundamental review, we learned the company goes 5 for 6 on the Select 6 analysis. The company earns high returns on capital and they've rebounded from their 2020 lows. While their growth has flattened in the last few years, Nike is still very profitable and they bring in a potentially attractive amount of cash flows compared to how they're being valued in the market. The company has also bought back some shares and they continue to be a dividend growth stock. On top of this, both short-term and long-term, their balance sheet numbers look very healthy. Still, Nike's going to have to overcome some headwinds and continue to be a market leader globally for the company to truly reflect today's valuations. When we put their qualities and their numbers together, today a fair value for Nike looks to be around $81 per share. That's up $10 from today's stock price. Nike looks undervalued. To find even more undervalued stocks, sign up for our investing tools, make exclusive requests, and get coverage of 107 stocks and counting.